So if as an investor, I'm looking at this as an acquirer's investor, I don't want my firm to engage in merger because this is going to happen to my share. As a target, my value is going to increase. But the managers don't seem to ex ante believe that they're going to end up losing value, despite the fact that in the long run, despite the fact that at least in the short run, the market seems to be punishing them quite a bit for this. Now, I think it's a fair statement because if we think about the efficient market hypothesis, there are three versions, one of which is the weak form, for which we have very strong evidence, which says that all the past information should be priced into the market. But then there is strong form, which kind of says that, well, private information should also be priced into the market. And for that, we don't have much evidence. So essentially, under the strong form, and if because of what we know, markets are not going to pick up necessarily all the information, especially if it's super private. So in that sense, managers are not completely wrong. But where they are kind of wrong is that they are not capturing all the synergies. They are not capturing all the cost savings as we would expect. So in the long run effects, we do see that managers are kind of not exactly, their foresight isn't showing up as much as we would expect it to show up. So essentially, the reason how we can reconcile this with all the previous evidence is that managers either don't seem to know that they are overpaying or that they willfully are hiding the fact that they are overpaying. So either it's maliciousness or it's ignorance. So why overpay? The first explanation that comes to us, so these are all the bad motives for mergers. So far, we did all the good motives for mergers. Mergers create synergies. Mergers essentially are going to create all the wonderful things for your particular company, the acquirer. But in this case, these are the bad motives, the downside of mergers. As an investor, you should be watching out for these motives. And also, if you, and I hope all of you do get really, good jobs in the future, if you are engaging in mergers or a third party participating in mergers, you should be keeping an eye out for these bad motives of mergers. So the first explanation comes from something called winner's curse. And this is not something unique to mergers. This is a general concept in economics, which really says that if you actually end up winning a bidding war, you might be overpaying. So let me provide you with a very specific example. But the idea being that managers overpay because they believe that they have private information about undervaluation of a given firm, which is not very unrealistic. If I genuinely believe that a company is being undervalued, then ideally I want to really overpay or pay what I believe to be the right value. So from the manager's perspective, the manager is not really overpaying because from their perspective, the firm is undervalued. So let me provide you with an example of this. Company C is the target, and company A and B are trying to take over this target company C. Now, company C has a market value of $10 billion, and company A and B CEOs believe that the true value of the company C is $15 billion and $14 billion, respectively. So A believes that it's $15 billion, B believes that it's $14 billion. And as an example, we happen to be omniscient, so we know that the true value of B, even after accounting for synergies, is just $12 billion. Now, what do we expect the CEO of company A and B to do? We essentially expect that CEO of company A is willing to pay more than CEO of company B. Why? Because the CEO of company A believes that the true value of company C, or the target, is $15 billion. The CEO of company B believes, on the other hand, that it's $14 billion. So B CEO is going to stop right around $14 billion, or at just beyond that mark. A CEO, if he's really rational, is okay going all the way up to $15 billion. So what happens is that they engage in a competitive bidding for C till A wins the bidding war and pays $14.5 billion. Does that make sense to everyone so far? So the idea very simply is that none of these CEOs from their end believe that their valuation is wrong. It's not like they are being malicious. They genuinely believe that the value is 15 and $14 billion, but the underlying value, which is very difficult to identify, mind you, is $12 billion. And that is why the question of what really is the value of a company is a very difficult question and also a very important question. Because as a shareholder or even as a CEO, you might be causing your company to lose about $2.5 billion. So what happens in this case is that the CEO of company A believes that she has underpaid because she believes the true value is $15 billion with synergy. Whereas in fact, she has overpaid because the true value is $12 billion. So the winner is the person with the most optimistic evaluation of C. And that is called the winner's curse. And this is in general something you see not just in, say, mergers, but even in auctions. As an example, Paul Milgram won the Nobel Prize in Economics. His work is in auction and mechanism design. And these sort of things happen a lot in auctions, where people who are the most bullish end up actually overpaying because they are the ones who end up winning. So the person who is the most bullish wins, and because they are ridiculously bullish, they actually end up losing because despite the fact that they have won the bidding war. So that is one reason why mergers might actually end up with the acquirers might end up overpaying. Now, there's this very nice quote over here by Warren Buffett. What he essentially says is that many managements...
Professor,
yeah?
Professor, sorry to interrupt, but in the previous slide, I think there might be a mistake in the first paragraph when you say when the true value of C, not V, I think.
Yes, you're right.
Sorry.
Thank you for pointing that. No worries. I will highlight that so that this is helpful and I appreciate it. So, yeah, thanks. So, and there's also a mistake here, but this is a quote by Warren Buffett, so that's his problem. So many managers apparently were overexposed in impressionable childhood years to the story in which the imprisoned handsome prince is released from a toad's body by a kiss by a beautiful princess. So what he's saying is that most of these managers essentially are engaging in a lot of kissing, but there are no miracles happening. Nobody's essentially becoming a prince, despite the fact that they are engaging in mergers. So what he's saying is that everyone engages in mergers, but very few people realize value, and he's saying that in a very sarcastic manner. Now, let's go back to the initial slide, which was about initial example, which was about RJR Nabisco. In that case, the winning party was KKR. And the question which was asked immediately by Washington Post, mind you, this is an article from 1988, is did KKR pay too much? Now we know that they did pay too much because they made a big loss on the entire investment. But even at that point, this is an example of how this particular author kind of pointed to the winner's curse. Now, mind you, it's very difficult to really identify winner's curse as it is happening, because how do you know, as an example, that a firm is overpaying? One dimension could be that, the market reactions, but on the other hand, it's kind of like what these managers say, which is that market doesn't necessarily always know all the private information. It's not like market was correctly pricing Tesla all this time. It's now that they have actually started, valuing Tesla really well. So in that sense, this kind of highlights when mergers are failing, it's very difficult to point out. And I will give you two more examples of how, from a perspective of a layman or even someone who does know all this, it's very difficult to identify when mergers are failing because of the fact that there's always the possibility there's private information. But nonetheless, on average, what the markets believe is right. So what they are saying here is that Henry Kravis, who was the manager the CEO at that point, is like the dog that chases the cars and finally catches one. So essentially a very different way of saying the winner's curse once again. So let's talk about the second dimension, which is agency problems. So what are agency problems? I'm pretty sure most of you might have come across this in some form or the other, because I do know in management this has been covered, in economics this is something which is taught as well. The idea being that, especially for public companies, the shareholders, that is the people who finance and own the firm, and the managers are not the same person. Because the manager is not the same person as the shareholders, as the owner, the manager has a different set of incentives than the shareholders. In other words, I am giving my money to someone else. That person doesn't face the risk of actually using that money. And as a result of that, there's a very good chance I might end up losing money. So that's where a lot of this contract theory comes in, which is how to write the best contract, wherein I can ensure that the manager essentially is doing what I expect them to do. So agency problems can take different versions. First is that the managers simply just decide to, take the quiet life route, as it is called. They do not do anything that is required, which is tough for improving the value of the company, because it requires effort on their end. But as an owner, you would definitely want to engage in these actions, but the manager doesn't have the incentives to do that unless we write the contract to force the managers to do what we want them to do. The second dimension is entrenchment, which is that the management tries to take moves to secure their positions at the expense of the shareholders. So for instance, this is a general thing when you start a job, one of the first things most of the people will advise you is make yourself irreplaceable. That's exactly what managers also do. Big CEOs of companies also precisely try to do that. The other dimension is excessive risk aversion, which is that they don't engage in any risky activity, because if it goes bad, then they don't really they are at the risk of losing their jobs. On the other hand, if it goes really well, it's not, unless the contract is designed that way, they are not going to get much of the rewards. And the final is overconfidence. Now, overconfidence bias is something which has been documented a lot in CEO behavior, and it's quite problematic because CEOs tend to be extremely overconfident about mergers. And as a result of that, they end up losing the value of shareholders a lot. So agency problems are one dimension. Now, one of this examples of this comes a bit more on the entrenchment and quiet life side, which is of F. Ross Johnson. F. Ross Johnson, as a quick reminder, is the CEO of Archer Nabisco. What he did was that, and actually if you read the book, or in my case, I didn't read the book, I listened to the audiobook, it's much more convenient, but still, if you either way get in your hands on the book, the idea is that this person, when he actually came into his job, he started building all these, essentially encouraging everyone to go on private jets. This was a company till that point where you had to essentially hand in the stub of the previous pencil to receive the new pencil, even if you were the CEO. And that's the change in corporate culture that happened around that time. Now, around that time, this was justified, saying that he's a superstar. So he's doing what is necessary to create value. So once again, if as an example, right now you see Elon Musk spending Tesla's money a lot, you're really not going to say, well, he's just being outrageous, so let's constrain him or remove him, because typically it's very difficult to identify what is necessary to create value and what is really value destroying. So if you were to, as an example, if Steve Jobs were around, if he were to do these things, then probably most shareholders would just justify it in one way or the other. So once again, agency problems can cause the firm to overpay, because essentially the firm's managers try to entrench themselves or basically destroy the value of the company. And that is malicious, as opposed to winner's curse, which is a bit more of ignorance. Everything clear so far? Okay, so I'll take that as a yes. Now the next is managerialism.
Yes.
And that is quite similar to agency problems. What it says is that if we think about managerial compensation, or actually in economics, there's a big debate right now about why managers are being paid so much when in, say, 50s or 60s they were not, at least in the US, is because firms have become very complex. As the CEO of a company, by the way, managers is typically the CEO of the company. As the CEO of the company, you have to handle extremely complex organism. And as a result of that, your compensation is linked to firm size. So the idea being that if the firm is becoming very large, you get compensated more because the justification is that the firm is becoming more complex, so you need more money to handle it, more compensation to handle it. So if you're a manager, think about it in the most evil way that you can. What do? You just basically make the firm larger. You go and acquire other firms, make the firm more complex, more opaque. You basically act very maliciously. And if the shareholders are not sensible enough, or if there's disciplinary problems on that dimension, then you're not going to get removed very easily. So from your perspective, it's actually very good to build large firms through acquisition. The other dimension is also empire building, which is where firms, managers actually try to create gigantic empires, empires being very large firms, because large firms are difficult to be taken over. So these are once again malicious cases. Winner's curse was not necessarily malicious. The second one, agency problem, was malicious, and this is also malicious. And to give you an example of this, once again, going back to why did this particular Mr. Johnson engage in the merger, in the buyout, or even suggest the idea? Because what happened initially, to remind you, is that he wanted to take the firm private by buying out all the public shareholders. And at that point, KKR stepped in and started competitively bidding against him. And KKR eventually won. So why did he eventually start this in the beginning? The first reason was because he was very concerned about the share price. So he, as an example in the book, he would spend day and night thinking about obsessing at the share price. And the other dimension was also because the company, because of all the excesses, was actually not doing that well. So in order to avoid a takeover, he actually just decided, maybe I can just, make the firm private myself without actually letting someone else in. That gamble didn't pay off because eventually the firm was taken over and he lost his job. But still, I guess the severance package he received was approximately $5 million, which was in 1988. I guess the prices must have multiplied by, I don't know, a factor of 20 or something. Still not a very bad number to go by. So all of these examples of why mergers fail to create value for the acquirer come from a bit more of managers overpaying side. These are the things managers themselves won't say, obviously, because they are the ones who are, talking about it. But if you're interested actually about someone feeling exposed regret, I would suggest listening to this interview by Ted Turner, who was the CEO of, I think the CEO of Time Warner. So Time Warner and AOL engaged in a merger. It was a terrible idea. And essentially, Ted Turner lost approximately $8 billion in his wealth. And then there's this very nice interview where he's being asked about it. And he essentially says that, well, I do regret it a lot. I was hoping actually we wouldn't do this interview because I knew you were going to ask this question. So typically managers do malicious things or stupid things many times, and that also causes mergers to fail. So far, I have been just trying to depress you about the whole mergers industry. And actually, if you study finance, you will realize that, funnily enough, we don't have a very positive data on most of the financial services, which is financial advisors typically cause you to lose money, mergers cause losses to their advisors, to the acquirers. So it's all doom and gloom. But that makes no sense, right? So essentially, why are then companies, is every company being run poorly enough that the managers, essentially can destroy value that easily? Or is it the case that we are missing out something? Now, let me, before I answer that question, are all mergers really bad? Show you this graph, which I showed you before. Now, this doesn't look like a good graph on average, but the key word being average over here. If you're at this point, however, the 17%, that's not particularly bad for you as an acquirer. Once again, if you're here, that's not bad for you. Also, in the distribution of returns, it's not as though every firm ends up losing money when mergers are announced. Every acquirer ends up losing money. There's a distribution over there as well. So if you happen to be on the right side of the distribution where you're actually earning money, that's not bad for you. So the question being, are all mergers bad? No. There are some mergers which do create value, and that is kind of what you want to identify. Not just as an investor, but also I hope that you become practitioners in the future. And at that point, you're able to identify what mergers create value and what mergers don't. One more dimension of this is that typically the media attention is focused a lot on very large mergers. So we are also biased. I mean, this is still data driven, but we are still very biased to look at something like Time Warner AOL failure or Heinz Kraft failure, where they have lost, basically they have screwed up everything. But the idea being that we are very biased on that dimension. So whether a merger succeeds depends on the target type, that is whether it's a public firm or a private firm, the form of payment, that is, are you paying with equity or with cash, the size of the target and the acquirer, but not necessarily on the acquirer experience. So I will be covering these three in depth. And this one I'm just going to mention very quickly. Serial acquirers do not necessarily produce better returns. There is mixed evidence on that dimension that acquirers often learn sometimes, but many times they also don't learn. So it's a mixed evidence that serial acquirers do not necessarily learn and start creating value for their shareholders. Remember, mergers on average create value, but all the value goes to a target. So we are here once again talking about failure from the acquirer's side. Okay, so I've been talking for quite a bit, and I don't want to prevent any questions. So if there are any questions, please feel free to ask. Okay. Okay. So the first exception is privately held firm. So the type of the target. Let me first pose an open question, which is, what are privately held firms?
Their stocks are not publicly traded.
Mm-hmm. That's right. So privately held firms are firms whose stocks are not publicly traded. Public firms are companies whose stocks you can just go and buy on the stock exchange. If you actually look at the trend right now, this is beyond the scope of this course, but very few firms are actually going public these days. There's a big puzzle as to why firms are not engaging in IPOs as much as they did. So private health firms are making a comeback. And in many countries, especially if you're talking about countries like East Asia, and in actually many European countries as well, there's a big tradition of more privately held firms than publicly held firms. In the US, there is a very strong culture of having publicly held firms with very diffuse ownership, which means that there are a large number of owners. Whereas, as an example, in Germany, the ownership is quite concentrated. So let me just first talk about why privately held firms, what happens with privately held firms. So let me interpret this table for you. This is from this study by Faccio, McConnell, and Stolen. And what it essentially looks at, I think, 17 different countries. And it looks at listed targets versus all unlisted targets and looks at their abnormal return. So abnormal return of the acquirer. Remember, it's the acquirer who is making the loss and not the target. So what they show is that listed targets, that is public targets, the acquirer is losing, just as we saw before. But for unlisted targets, that is private firms, the acquirer is actually gaining. And I guess this is something you might have come across in your empirical methods course. These stars indicate significance. So in this case, actually, it's insignificant. In the other case, it's significant. And the difference is also quite large. So the difference between this and this is quite large. So what this shows us is in a study of 17 different countries and mergers in those countries, essentially private firms acquiring private firms is a good idea for the acquirer, whereas public firms is not necessarily good. Now, why does it really matter? Can anybody venture a guess? Okay, so let me help you out then. One dimension is that many times sellers of private firms just want to cash out. And also one more dimension, which I will clarify here, is that it is a bit difficult to identify the value of private firms. First of all, you don't have necessarily data on all the balance sheet and everything of private firms all the time. They don't have to issue prospectuses. And also because they are so opaque and privately held, you really don't know their true value that easily. So in this sense, looking at the acquirer's returns is the best approach for us to actually see whether there's any value gain happening. And here, what we can see there is. So one dimension which Faccio and Masudis have talked about, which is that sellers of private firms often want to cash out to retire. If that is a bit naive for you, it's also the case that bidders, actually, I'm sorry for this, this is also one more typo, bidders might underpay to compensate for the risk from information asymmetries. Because you really cannot identify the value of a firm, why would you try to overpay for that firm? So that might lead to this positive acquirer returns. Now, one more dimension is that the seller might be naive. Now, I'm not entirely sure I agree with this, but nonetheless, this is the theory proposed by Capron and Shun. But nonetheless, the idea being that the sellers of private firms might be naive or have preferences for firms to be managed a certain way. Now, this second part might once again seem naive. When you're selling a firm, why do you care whether it's being managed one way or the other? You are selling the firm, you're getting out of it. But as an example, in the case of Argia Nabisco, it was Ross Johnson who actually proposed $112, and KKR, who won the bid, who proposed $109. And KKR won, despite offering $3 less per share. The reason being that the management of the firm actually wanted to have the firm managed a particular way. So that is not a trivial dimension to really talk about. Now, the second dimension is exception is the form of payment. So as a company, you can say issue stock. So you can issue stock to the acquirer for the target and then buy that particular target. How this would work is in multiple ways, but one way is something like stock swaps, where you ask the shareholders of the target, give me your stock and I will give you the stock of my company instead. So in that sense, you can pay for something for acquisition using a stock, or you can also finance it just using cash. So this kind of goes back. I don't want to jump all the way back to the beginning of the presentation, but this kind of goes back, if you remember, in the slides, in the motives of the managers, there was this nice little thing which said using excess cash. So cash is often used, excess cash is often used as a form of payment. And what we see over here is that those firms which are financed, those acquisitions which are financed using stock typically are underperforming. And they are significant as well if you're looking at equal weighted portfolios. Whereas if those which are not financed with stock, with cash as an example, actually end up gaining value in the value weighted. Now, these are not significant, I agree with you, but there are other studies which do show that cash financed payments actually create value for the shareholders of the acquiring firm. Now, why is that the case? If we think about finance, everything that we learn is basically that Modigliani Miller, the way a particular firm is, finance doesn't matter for its value. The Fisher separation theorem. It doesn't matter how the shareholder, how the actual, manager of your money really uses the money. It's much more so that that person should get you the highest return. So, in other words, there's a separation of the use and the financing of money from the actual returns developed on that money itself. And that is a general theme. But those are themes which come with a lot of assumptions. And in this case, the assumptions don't really hold anymore. So, this is a very sort of foundational paper which says it's called Myers and Mashlow 1984. If anybody actually knows how to pronounce Mashlow, please correct me because I don't know how to pronounce that name. The idea being that in most cases, managers of firms with overvalued stock are likely to use stock financing. And because of that, investors who cannot distinguish between overvalued and undervalued stocks actually think that all stock transactions are overvalued due to information asymmetries. So have any of you come across Market for Lemons by George Akerlof? Okay, so lemons are basically, it's a colloquial US term for really bad cars. The idea of Market for Lemons is that if you go to a second-hand car shop and ask the seller to give you a second-hand car, and say out of 20, around 2 or 3 are complete lemons, then and you cannot distinguish between the lemons and non-lemons because perhaps you don't know much about cars, then you will think that all the cars over there are lemons, and you will want to pay the price for the lemons. You won't want to pay the price for the better cars because there's a chance that you're actually getting the worst cars. Now, what happens as a result of that? The seller starts reducing the quality of cars that they are putting out because the price has reduced. And because the price has reduced now and the quality of cars is also going down, when you go back next time to that shop, you don't want to once again pay the price of the lemon either. You want to pay the lower price because now there are more lemons in the entire shop. So this goes on till basically the market collapses. This is not exactly that, but it's kind of getting there. Because managers of firms with overvalued stock are likely to use stock financing. And as an investor, you cannot say which company is overvalued and which is undervalued. You think all stock transactions are overvalued, and which is why you always discount stock transactions, which is why, because of that discount, essentially stock-based transactions cause losses to the acquirer, whereas cash-based transactions do not cause losses to the acquirer. Because with cash, there's a very clear signal. Money is money at the end of the day, but with stock, you don't really know the underlying value that well. Is this clear, or shall I explain again? Okay, so nobody has answered. I'll take that as a green light. Now, firms with excess cash, the other dimension, the reason why form of payment matters is that firms with excess cash can use their slack to finance constrained firms. To give you an idea, if there's a really great startup and they don't have enough money to finance their innovations, and Apple has a lot of cash on their hand, they can just use their Slack to pay that startup and create a lot of synergies, because a firm needs money, another firm has money, and there's exchange of money that creates synergies. So in this case, once again, the form of payment creates value for the acquirer. However, and I will not bore you with the exceptions in depth, because once again, I think then we'll just go down the whole rabbit hole. The equity finance deals in Europe outperform cash finance deals. The reason for that is, as I said, in most European countries, there are large shareholders who can monitor targets. So in that sense, the information symmetries are lower, and also monitoring is better because there are large shareholders who know the inside out of the firms. And the second dimension is that using stock to buy privately held firms results in positive abnormal returns, because the large stockholders can monitor targets, and because also they can sort of share the risk by issuing stock with the target shareholders. Now, what is the second dimension? First of all, this is in line with the first exception to mergers creating losses, which is privately held firms. The second dimension comes from this, which is that, as an example, if I am, taking over a firm, I don't know the real value of that firm, and it's very difficult to find out the privately held firm. Then what I would like to do is that I would like to give stock or a claim on the firm to the target shareholders, because if I'm overpaying, they are also going to end up losing money because they are also getting that stock. So it's like I lose and you lose. And because of that, using stock to buy privately held firms actually ends up with better outcomes, because the target shareholders would not want to, basically sell it at too much of a premium either, if they are actually holding on to the stock afterwards. Now, I promise this is the last one of the exceptions, which is firm size. And my apologies for this slide being so small, but I can do this. What this shows is that when is this the acquirer? Yes, when the acquirer is large, the normal returns are negative. When the acquirer is really small, the abnormal returns are positive, and they are also significant. Now, that's just in terms of abnormal returns so far, but the nice thing about this study is it also looks at actual money. So if you're a large acquirer, you lose out $47.9 million per transaction. If you're a small acquirer, you actually end up gaining $1.7 million. And I think they do a calculation in that study, and they show that it roughly works out to around $200 million across the firms in a given year. So the idea being that just the difference between large and small acquirers makes a big difference in terms of the acquirer returns. So small acquirers, when they acquire firms, they actually end up getting better. Large acquirers on average end up losing. This is a very nice fact, because if I'm trying to look at value mergers, this is exactly the kind of thing I would want to know. So there's inverse relation between acquirer as well as target size and acquirer returns. The reasons being that larger acquirers overpay for defensive acquisitions, which is that the empire building thing. Managers essentially want to create gigantic empires so that their companies are not taken over. That's exactly what's happening over here. The second dimension is that smaller acquirers, on the other hand, often want to make themselves attractive targets because they are not going to earn too much profits anyway. So they try to, get the best acquisitions. So the motives of the managers in these two cases are very different. The second dimension is that larger targets are riskier because of integration issues and problems with synergies. And I realize I've been talking for a very long time, so also let me take a break and let's do something which is a little less, monotonous. Let me talk about integration issues here. And actually, let me do this.
What went wrong with craft time? Well, I think, what happened yesterday really makes it official that Kraft Heinz strategy is
Teacher,
what they've been doing
Yeah.
for years.
nothing. Sorry, nothing.
Can you hear the video or?
Yes, we
I can see the video. I
Yes.
can see, thanks. I can see.
Okay.
This is really the 3G playbook where they take over famous brands, they wring efficiencies out of them. But sales at Kraft Heinz fell for 6 quarters in a row after they did all this cost cutting because they were underinvesting in their brands, underinvesting in marketing and innovation. And now, they're paying the price.
And I always, Aaron, thought it was so interesting that Berkshire Hathaway was involved because, of course, it's important to have discipline when it comes to management, but that's not typically the kind of Warren Buffett story, right? I mean, he likes great brands because they're great brands and they should be able to grow and thrive, not necessarily because you're going to cut expenses down to the bone, right? I don't want to, I hate to ask you this, but what do you think he's thinking right now?
Well, I think you guys are going to ask him that on Monday.
We don't,
But,
yeah.
I think, it would serve him well to give us an explanation of what he think went wrong, why he was wrong, frankly. I think one underappreciated aspect of the story is that Warren Buffett lends 3G not only his financial credibility, but also his kind of all-American down-home image.
Yes.
Because otherwise, I think there would have been a lot more resistance to this foreign Brazilian private equity firm coming in, taking all these iconic brands, laying people off. The whole thing went over better because, Berkshire Hathaway and Warren Buffett were involved.
And Leslie, that brings us to the story of the 3G, iconic now Brazilian firm who's done this with a number of different companies and industries. Did Kraft Heinz specifically go wrong for them, or have they been struggling on multiple fronts?
So the 3G mantra, they were founded in 2004, a Brazilian businessman who was known really for his work in the railroad industry, kind of built this firm from the ground up with this ethos of cost cutting and roll-up strategies through acquisitions. Now, a couple other areas where they're invested right now, Restaurant Brands International, which is doing quite well.
Compared to Burger King.
That, I would say, is kind of a mirror image of what's going on with Kraft Heinz right now. But they also were responsible for the roll-up of Anheuser-Busch InBev, which is struggling a little bit more. So I wouldn't say either of those are really akin to what's going on with Kraft Heinz, but it certainly does call into question this whole 3G cost-cutting model, because if you can't get that acquisition machine going,
Right.
and you're doing what they call zero-based budgeting every single year,
Right.
does it ultimately serve every company in a way that would be most beneficial for the shareholders?
And Aaron, you wrote about this too. You said before, and for a couple of years, people have been saying, okay, what's the next? I don't mean this to sound the way it is, but there's a little bit of an analogy to Valiant when it sort of thrived on repeated acquisitions in order to grow and increase earnings. That is a totally different story. But in this case, people have been saying to 3G and the issue of Kraft Heinz, what is the next big acquisition going to be? And today you're saying before they do any other acquisitions, they have some explaining to do about why that would make sense and why they're not going to get back to it.
Okay, so I think now they are drifting off the topic a little bit, but the idea over here is very simple. That Kraft and Heinz, okay, I guess I can do this. Kraft and Heinz are these two very large firms which basically merged. And what happened was that there were a lot of integration issues and problems with realizing synergies, mainly because of cost cutting. They engaged on this very aggressive cost cutting dimension because they had far too much debt, were making far too many losses, and they were not very well integrated. And that is kind of the idea of larger targets being riskier. Because when you take over a large firm, and this is going beyond actually finance into a bit more of management side, it's not just that you're acquiring a firm, you're acquiring the personnel who are in that firm. You're acquiring the business processes which come with that firm. And what happens is that if you're not going to be able to align those really well, then you're going to end up with a lot of losses, a lot of other things like this. So in that sense, firm size, smaller firms are much better targets because you have to do much less of this post-acquisition integration. Okay, everything good so far?
Yes.
Okay. So let us move a bit to the last aspect of this lecture. And today's lecture is going to be a bit shorter than the previous ones because I'd allocated a bit time for technical issues. Thankfully, not too many popped up. But what have we missed so far while studying value creation and destruction? So before I show you these two videos, I mean, so far, what have we really looked at? We have looked at the value of a shareholder. I am a shareholder of a company, and I actually end up losing value. So what have we missed so far? If we really think about value, what all directions can we go? Anybody? So let me show you these two videos, and I guess it might become a bit clearer in that sense, but let me just do.
Entertainment at El Dorado Resorts. The Union for Hospitality Unite Here says it's worried that merger will lead to potential job cuts and gaming tax revenue declines. Unite Here represents almost 25,000 workers between the two companies. Still, the deal is expected to close next year if it's approved by gaming regulators and shareholders.
I think that was it. But in this case, what they were getting at is that value extends beyond simply the shareholders. There are other stakeholders in the process, such as workers. Now, of course, we don't focus on that much because much of finance, as Robert Schiller once humorously said, is about making rich people richer. But if you're going to engage in mergers, there's also a lot of value loss which occurs for stakeholders other than simply shareholders, such as workers. Now, in this case, we don't know whether this was a bad merger or a good merger. But as an example, I hope that I have the AT&T example. No, I think that is a different one. But in the Heinz graft as an example, one of the things which happened was that Warren Buffett is actually getting a lot of returns on this particular merger, but the workers are ending up losing a lot. So in that sense, there are multiple dimensions to value beyond simply shareholder. Value is the most obvious dimension. The stock prices are the most obvious direction, but there are other directions which come across from the side of, say, the workers, the suppliers, the customers, and so on. So now let me show you one more clip over here. This comes from AT&T. If you have been following net neutrality, the role of big firms was front and center. So this is quite linked to that.
Mobile US saying it is a $39 billion deal that would make it the biggest cell phone company in the country. But is this good or bad news for consumers? CBS News Business and Economics correspondent Rebecca Jarvis is here with us for the details this morning. Rebecca, good morning.
Hey, good morning.
So what's the probability that a deal this size is actually going to go through?
AT&T thinks it's going to get done in the next 12 months, but the analysts I'm talking to say that it's going to take a lot more to get this deal approved. There will likely be many, many strings attached, and that's because when you consolidate these two companies together, AT&T and T-Mobile, all of a sudden you shrink the size of the overall industry. AT&T right now is the largest carrier. They have 95.5 million subscribers. Once you add on that 33.7 million subscribers that T-Mobile has, all of a sudden you have this mega player in the industry, and that means less competition for consumers, and that means the consumers can get snubbed as far as pricing goes, as far as service goes, and as far as offerings and innovation go. That usually tends to be the case when you have only a few players in an industry.
If you're a T-Mobile subscriber right now, will your service change for the better or for the worse, potentially?
See, that's the question that everyone wants to know. And AT&T, generally speaking, rates the lowest among consumer reports for service as well as customer service. So for T-Mobile people who then get switched on to the AT&T lines, because once this deal does happen, if it does happen, the whole company is AT&T. They absorb T-Mobile, the T-Mobile name goes away. So essentially, there's a sense that perhaps some of that T-Mobile service that people are used to being slightly exemplary to AT&T is going to go away.
Well, what if you're an AT&T subscriber already, and then you're adding on almost 40 million others? Does your service suffer potentially?
Well, it could suffer potentially, but the case that AT&T is actually making right now, and it's a case that they're making to get regulators to approve this deal, is that in rural areas in particular, service is going to increase and it's going to go up. They are building out towers in New York and San Francisco as well. So AT&T is making this argument that service for AT&T consumers could actually improve, and that's why they say the deal needs to go through.
Okay, so maybe service will get better potentially, but you talk about there being less, I guess, less pieces of the pie out there, less options. So what about pricing now?
Yeah, pricing likely could go higher. I mean, this is what generally happens in an industry where you have a handful of players competing for dollars. Well, all the players have to diversify on their pricing. T-Mobile was the lowest cost carrier out there. Well, now when you subtract them out of the equation, AT&T can have the power to actually increase its prices.
Now, if you are a T-Mobile customer right now, should you be thinking about, well, maybe I should make that move and get an AT&T phone, just to kind of head off something that's going to potentially happen here?
There's no reason to do that because phones that have this T-Mobile insignia on them, they, with the T-Mobile logo, as long as they're second and third generation phones, they will be covered under the AT&T plan. So there's no need to rush out and get an AT&T phone.
Can I ask what this does to some of the smaller carriers? It's tough to think of Sprint as being a quote-unquote smaller carrier.
Right. Well, the reality here is that there's a major concern that if Sprint faces the competition of Verizon and AT&T, these two mega players, it could really hurt Sprint down the line.
All right, Rebecca, thank you very much. Good to see you.
So what we gathered from those few examples, and I have it's here, is that there are multiple stakeholders in the whole merger process beyond simply shareholders. The shareholders are the most obvious, and from a finance perspective, they are the most valued, at least the ones we focus on a lot. But on the other hand, if you become, say, enter policy, or as an example, even if you become practitioners, from multiple dimensions, other stakeholders also matter. As an example, bondholders who issue debt to the company. Bondholders who issue debt to the company, they matter a lot. Employees often matter because employees are the first ones to get the job as soon as mergers occur. And customers matter because, as these people discussed, when big monopolies are being formed, the customers are ending up losing welfare. This is a bit more of the economic side of things, but I feel nonetheless, given that many of you might become practitioners in the future, it's important that you have an idea that stakeholders and value just goes beyond simply stock returns. So the effect on bondholders, there's mixed evidence for acquirers, positive effect on bidder. I won't go into much depth into this, same story. Effect on employees, wages and employment decrease. When local market concentration increases, my apologies, this should not be here. So local market competition increases, so in other concentration increases. In other words, mergers are fine for employees, so long as the local markets essentially don't end up becoming super concentrated. In other words, if you don't have gigantic monopolies, then mergers still don't have much effect on wages and employment. So here, let me very quickly show you an example. What this shows is that when mergers occur, employment decreases, so people get fired more, something we already know, and this is to the tune of approximately 0.15%. Is that it? Yeah. And then there's also effect on workers who are already working there. So if you're in a firm which gets acquired, then your earnings can go down. Of course, this is all workers, so it's not necessarily top managers. There's a good chance that you might actually leave your job voluntarily, and the earnings of stayers, so workers who actually stay for the longer run, also go down. So for employees, this is quite bad. So if you're talking about value, it's not just the acquirers who are actually ending up losing sometimes, but the employees end up losing a lot of times. For customers, on the other hand, there is actually a price drop, surprisingly. So prices don't go up much. And on the other hand, the quality goes up. So from the customer dimension, surprisingly, mergers are quite good. Now, I'm pretty sure there will be a lot of studies, but this is one of the ones which has I mean, one of the more recent ones, which has actually done a very good job with very unique data to really identify the effect. So in this class, which I hope that it was interesting for you, we answered some questions. Do mergers create value? Yes, they create value on average, not just for the acquirer all the time. There are bad reasons why mergers don't create value. And also there are reasons as to why mergers do create value in certain cases. And those are cases we want to look out for. We also learned that other stakeholders matter. It's not just the shareholders. And if we actually listen to barbarians at the gate, one of the things that they talk about is that previously in American corporate culture, it was very common for CEOs to care a lot about all stakeholders, but now it's just become about shareholders. So previously they would also care about, say, workers, but now because of the death of labor unions over there, that culture has gone away, where it still persists in many European countries. So we have addressed some of the big questions that come alongside mergers. And the questions that we have not answered are how to value a merger, which is the core. So how do we value synergies? How do we value control premiums? So just the value that we get from controlling a firm. What drives the financing choices of these firms? So why do they choose leveraged buyouts and not cash or stock? And how do different types of mergers and acquisitions differ? So private equity as an example, where they buy firms, change them around, and then sell them, or conglomerates, which we talked about a little bit. So those are the questions which we have not answered. And finally, in case of, once again, going back to Arja Nabisco, what happened in the end was that the firm was sold off and broken up because KKR had an exit strategy. So if mergers don't go well, what is the exit strategy and what does it look like? So we will be covering this in lecture 3, financing choices of firms in the next lecture, types of mergers and acquisitions in lectures 4 and 5, and exit strategy in the final lecture. So thank you very much for being here. I think today's lecture has ended. I will be still on call in case you want to ask any questions, if you have any doubts. This lecture was a bit of shorter one. Next time onwards, we'll try to use up the whole time, but I would like your feedback on the breaks and things like that so that we ensure that we are all, not zoning off, because it's very difficult to maintain attention for 3 hours straight. So the lecture for today is done. If you guys have any questions, feel free to stay on the call, ask me any questions. Otherwise, we are done for today. What I will be doing is I will be putting up the slides and other material on Thursday. I need to fix some issues with Moodle. Sorry. What were you saying?
Professor, can you repeat what you said about the slides? Sorry.
I will be putting them up on this Thursday. I have a bit of issues with Moodles right now, so I will take care of that.
Thank you very much.
Do you already know when we are expected to complete the case, or when we are expected to do the case study, which counts for 30% of the grade?
Mm-hmm. So, okay, just let me save this. Yeah, so the thing is, the case study is something I cannot introduce till I teach evaluations, because that has to be done first. So what I will do is I will try to introduce the case study immediately during or after the class of valuations. And I do not ideally want to keep the deadline around the exam. So if it is allowed by the administration, then I'm also comfortable keeping it after or a bit before, or reducing the workload of the case study so that we essentially don't end up creating this double deadline for you where you have to study for the exam and for the assignment at the same time, which is not pleasant because you have multiple courses and not just this one.
Okay,
so
great.
yeah. Okay, so are there any questions? If there are none, then I will go off the call. But yeah, sorry, someone had a question.
Yes, I have a question. It was about when a company finances a merger with stock. I did not really understand. It was undervalued, is what you said?
So let me open up the slides again.
Because I was taking note and I did not really understand this part.
Okay, so so I guess you are talking about this one, right?
Yes, yes, this one.
So the idea over here is that essentially, if you are a manager of a firm with an overvalued stock, what would you do? You would want to take advantage of that and issue a lot of stock, right? Because as a company, people are buying your stock for more than market value, or more than the real value. So now think about it this way. If there are some crooks who are issuing stocks at higher value, and you as an investor do not know who the crooks are, you might start assuming that all companies which are actually using stock to finance mergers are all crooks, right? So that's the whole idea why I gave the example of the cars. If you don't know which cars are bad, you might just think that all cars are bad and you will be willing to pay less. So from that perspective, the investors will always try to put a discount on stock financed acquisitions because they cannot distinguish who the crooks are and who are not. So in that sense, cash is a very good signal because cash cannot be messed around with very easily.
Okay.
Does that clarify?
Yeah, it's better. Thank you. Thank you very much.
May I add some kind of different explanation for that? Like there's some form of what you can tell is like if the buyer's yield is low, then it is an attractive form of financing. So like if the value of the company is very, very high, then you have a very low yield. Like the yield is defined basically as earnings per share over the price. So if the price is very high, that ratio is very low. So the kind of foregone yield the existing shareholders will have if like they wouldn't engage in the deal is very low. So the cost of financing is very low. And that is also like kind of similar to the case with cash. Like interest rates are currently very low on cash. So if yeah you do not have that cash anymore, the foregone interest rate is very low, so it is very cheap to finance the deal with cash.
That's a very good point. That's an excellent point. Yes.
Excuse me, Professor.
If you don't mind, I'm going to sit down because I've been standing for the last like 2 or 3 hours. So, yeah. All right.
Sorry, I have a kind of an administrative question. It's regarding the Moodle page will still be open after the add and drop periods. Because I didn't manage to catch a place yet. I'm still trying on the add and drop, but I would like to, even if I'm not enrolled, like to watch the lessons and see the slides. I would like to know if it will be open or it will be closed after the add and drop period.
So technically, we are expected to close the guest access. That's something we are asked to do. Having said that, from my perspective, if someone just wants to audit the class without taking the exams, that's perfectly good for me. I don't mind at all. So I mean, I don't know whether there's an official way of doing this, but the enrollment key is essentially all you need to enroll for the course. So if I put up the enrollment key, then you can use it and enroll for the course, and you don't have to necessarily take the exams. I'm afraid I'm not very familiar with Moodle. It's a very obtuse thing for me as well. So I don't know whether if you enroll for a course, you kind of are obliged to take the course exam or something like that. I don't think that should be the case, right?
Yes,
I hope someone else can answer that. Is that the case, that if you enroll for a course, you have to take the exam, or?
No, I'm not obliged to.
Okay, okay. So you're not obliged to. Otherwise, you're also on this Teams group. So this Teams group is not going to change. So in that sense, you have access to all the future scheduled meetings anyway. And for TP session, this is always going to be the time, with the exception of the third week, where we are going to have some national holiday or something. So that's the only week we are not going to have a class. But yeah, so from my end, if anybody just wants to audit, that's perfectly good as well.
Okay, thank you very much, Professor.
No worries.
Will it be possible to form a group with people from both sections?
Yes, so for me, I don't believe in bureaucracy, so I think it's perfectly good if you make your own groups and the number as well. So in that sense, in both sections, it's perfectly fine by me. I don't think there should be any official restriction on that. I'm afraid on the administrative side of things, I personally am very underinformed. So I cannot be helpful, but from my end, I don't mind at all if you form groups across sections.
Thank you.
No worries. Okay, so are there any more questions? Because I think many people are just holding on are on the call for the question dimension of it. So if you have questions, then feel free to ask. And if you don't want to ask openly, I mean, during this, I understand you can also just email me later on with any complaints or any suggestions or any questions. That's also perfectly good. Also, it would be good to have your feedback on the organization of the lecture, because this time we finished about half an hour early. That will not be happening going forward. So I don't know whether 75-minute, half an hour break, 75-minute is good for you or not. But as I said, just feel free to shoot a message or an email, and I'm more than willing to answer. Okay, then if there are no more questions, then let's end this meeting. What I will be doing is I will put up the slides on Thursday. I will try to record the Friday session so that you have that session recorded. And let's make this a habit so that the last session, which I do, typically I'll be a bit more polished while speaking, it is what it is. And then I'll put that one up online, however it works. So yeah, I will see you hopefully next Tuesday, and stay safe.
Goodbye.
Goodbye. Bye-bye.
Goodbye.